Hi there. So in this video we are going to go through chapter 9, which is about books of prime entry, the return. But before that, let's look at the answers and the concept of chapter 8. So in the previous chapter, chapter 8, we specifically look at purchase journal and sales journal. So we know that in purchase journal we have trade payables, and in trade receivable we have sales journal we have trade receivables, right? So we know that we record them in this format, right? We have date and then detail and then credit note, not the credit note number. In the previous chapter we had the invoice number. If you look here, we have the invoice number, and it's a bit more organized than the one we will be looking at the moment. So for this question, for this chapter, we have the answers here. So I think I went through question 1, 3 and 5 in class. I don't think so. I went in the recording, but let's look at the answers all together. I'll be just skimming through the answers very quickly. If you have any question, if your answer is not reconciling, not matching, then just let me know, and then we can maybe discuss further about the questions. Yeah. Uh, but for this chapter, I feel the questions are pretty straightforward. So here we have the name of trade payable because it's trade purchase journal, so we know we are going to look at the trade payable. So if you find it easy, maybe you can just write TP for your reference. So whenever you write trade payable, you can write TP. So if you notice, there is no debit and there is no credit, and this is just one side because we know this is a purchase journal and it's equivalent to trade payable. And what we do here is that only one entry, and then we have to transfer it to ledger after we finish. After we finish, you can say, or after the month, let's say, you can say, because they have given the couple of entries. So all these are the names of trade payables, and we record the invoice number, and then we record the amount, and then we total up the amount and we transfer it to the purchase account. The total amount goes into the purchase account, okay, not in purchase ledger. Purchase account falls under general ledger. Under purchase ledger we have trade payables. Okay, maybe I can write here, purchase ledgers are trade payables account. So these are the accounts of individuals. Yeah, so if you see, these are the names of individuals. So how do we get these names? These names are from here. Yeah, it's just a recap, so don't worry about it. So you just have to see how much is the amount for, let's say, Whiteford. We have 1230, so you can have it here. And then we have Sackley, so we will open another account for Sackley and then transfer the amount here. And then we have Harrington, another credit amount. And then we have another for Whiteford, so you can combine them. If you want to combine them also, it's correct. If you don't want to combine them, it's fine. Okay, but here it must be combined. Here it's only one transaction. Okay, here it's the total, and here we split the transactions because we want to know how much each person bought. If I combine them like this, I won't know who owe me how much. Okay, I won't know who owe me how much. Okay, so that's why we combine. And why this one is debit? Because purchase is an expense for us. Okay, purchase is an expense for us. If you follow Alice, expense should be debit, and these are trade payables. So trade payable is a liability. All of them are trade payables. Yeah, all of them are trade payables, so we credit them. Okay, so that was the concept in the previous chapter. Second question is pretty similar. Here we have the total of 4,600. Just check it back. Did you get the same? Did you transfer these two amounts into the same account? And did you transfer for Harley? Okay, did you transfer the same amount? And then just check back your total, reconcile with your homework. And then we have sales journal. So sales journal is income. Here we have trade receivables. trade receivables, and if you look at the sales account, this will be treated as income. Now remember, sales account, okay, here we have sales account which falls under general ledger, but sales ledger will have trade receivables. So trade receivables are assets, so that's why they should be all debit, okay, and the total again we have here credit. Just check back your answer, you should be getting this one. Question 4, your total should be this one, and then these are the values you should be checking back. Okay, now usually how the marks are allocated is you will have 1 mark for dates. If you get all the dates right, you will have 1 marks, and 1 mark for each transaction. Okay, so let's say here we have 4 transactions. This question will have 5 marks because 4 for this and 1 for dates. Okay. Okay, question 5 is about trade discount. So here you have to focus on trade discount. If you remember in the previous chapter, I told you how to calculate trade discount. So if they ask you that the 700 is the amount and 10% is the trade discount, then you take 10% of 700 and minus it with 700. You should be getting 630. So 10% of 700 is going to be 70, and then the amount is going to be, the net amount is going to be 630. Yeah. So here we are going to do similar thing. Okay, here we have purchase, so this is how much we are receiving, this is how much discount we are receiving. So this is not going to be discount received but more of discount allowed. But we are not going to record this. Remember, I told you there are 2 types of discount. One is discount allowed, one is discount, okay, cash discount, and one is trade discount. Where is it? Okay, can't seem to find it. Okay, I can't seem to find it, but there are two discount. Is it here? It's not here. Okay, never mind. But there are 2 types of discount. Okay, so discount, we have discount number 1, we have trade discount, and we have cash discount. So we do not record this one, we do not record this one, but we record this one. What I mean by we do not record this one is we just minus it here. Okay, so we get this total, right? In our journal, are we preparing journal for that one? Yeah, we are. So let's say in our journal, here we have purchase journal, right? We are only going to take 540. What happened with this 60? We are going to ignore it. So no debit, no credit. That's what I mean by not going to record it. Cash discount we are going to study in chapter 10, and I will explain you how it's recorded. Okay, so I think we can ignore it for now. So you are going to calculate trade discount, but you are not going to debit or credit this 60 ringgit. It's going to stay here. And then we have so these, just check back your calculation, because trade discount is more on how you know how to calculate the percentage. If you know how to calculate the percentage, you should be getting these values. So once you get the value, you can transfer this amount back in here. Okay, so if you transfer this amount, you should be getting this one. If you get it right, you can just check it back, and you should be getting total of 6,207 for sales journal and 3,744 for purchase journal. Another similar question. Okay, your trade discount should be this: 800, 150 for question 9, and 480 and 396 for sales. This was for purchase, this is for sales. Purchase journal, you should be getting these values. Sales journal, you should be getting these values. And then once you are ready to prepare journal, once you get these values right, you can transfer them into ledger. So remember the cycle. We have journal first, one we have journal, then we prepare ledger, then we prepare trial balance, and then we prepare income statement, and then we prepare balance sheet, or we call it statement of financial position. Statement of financial position. Okay. This one is also called actually comprehensive income statement, but comprehensive statement, but we are not going to look at the terminology at the moment. Okay. So here we are done with this one. So this one is journal, and now we are going to post it into ledger. So again, this is purchase ledger. So it will have trade payables. Okay, trade payables, trade payable, sales ledger, trade receivable, general ledger, purchase account, sales account. Check back the values. Yeah, you are getting the values right. Then we have question 10, kind of similar. You are supposed to calculate the trade discount. Just check you get the trade discount right. You get the total right in purchase journal, the values here, sales journal, the values here, and then this values. Okay. Then we have question 11. The total is 11,050, and purchase journal the total is 7460. You should be transferring it again here, 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 here. So why we have this transaction here? So we have this transaction because the customer paid. So when the customer pay, what happened is you debit your bank account because you receive money, and you credit your trade receivable. Okay, I can just write TR. So we credit the trade receivable. So he is paying us. He is paying us. So we credit him. Okay, we credit him, and we debit our bank account. Okay, depending on if we are preparing bank account. So in this case we are preparing bank account. So if you see, we credit him and we debit the bank account. So other cash transaction directly go into the bank account. Okay, so we have here capital account, balance only, no further transaction. Cash transactions, we have sales on cash. Where is the sales account? We should be having sales account somewhere here. Okay, so we have cash sales. We have from the sales journal coming here, and this is the balance brought down. Okay, just check your balance brought down is correct. Okay, and then here we have for purchase is this bank cash purchase, which will be, I mean, you pay immediately, that's bank. And then this amount is coming from journal, this one. It should be this one. Okay, 11,050. So if you recheck here, 11,050. Okay, so these are the answers. You can check. Did you get right for general expense? Did you get right for universe supplies? Did you get right for purchase? Did you get right for drawings? So if these all are credit, in other accounts, you know it's going to be debit, right? So for example, let's take this example, universal supplies, right? Let's find our universal supply here. So if you know this one is credit, this one is going to be debit. Okay, so again, so if you want to check your answer, pause the screen, go through the answers slowly, understand them, and then we can move on, right? Okay, so after this you are supposed to prepare trial balance. We have gone through trial balance. For this you are supposed to follow lies. Okay, okay, for this one you are supposed to follow lies. If you follow lies, you should be getting right. This one is asset, that's why debit. Credit, capital. Cash is debit. Asset, drawings, I told you, starts with D, so remember debit, drawings. Asset, expense, so debit. Purchase is an expense, debit. Sales is an income, credit. Trade payable, all of the trade payables, liability. All of the trade receivable, asset. Vehicle is an asset. Wages are expense. Okay. Question 12 is also similar. You are supposed to prepare the journal first, purchase journal, then sales journal, then the accounts for trade payables, and then accounts for trade receivables, and then your other all the other falls in general ledger. Okay, so I told you, if you remember here, we have certain transaction that falls in purchase journal. So purchase journal are usually only trade payables, and sales journal is trade receivable. So anything else falls in general journal. If it's not falling in these four categories, it's probably general journal. Cash book, I told you, is a simple trick. If it includes the term cash or check, definitely cash book. Doesn't matter it's a sale, it's a purchase, or it's whatever it is. As far as the statement includes the term cash, it goes in cash book directly. Okay. uh, Bank loan liability, interest is an expense, so debit. Capital, cash, drawings, expenses, premises, purchase account expense, sales account income, asset expense, and then we transfer all the items into trial balance. It's an asset, it's a liability, interest is an expense, capital is capital, credit, cash is an asset, drawings, debit, expense, premises is asset, purchase is expense, sales is income, trade payable, liability, receivable, assets. Actually, exactly the same format. If you can do the question 11, you can definitely do question 12. They are overlapping actually. Okay, let's jump into the next chapter. So previous chapter we look at purchase and sales journal. Now we are going to look at purchase return journal and sales return journal. There is like literally no difference in terms of formatting. Okay, there is no difference in terms of formatting, but there is a difference what you record in purchase and purchase and sales return journal, and what you record in purchase and sales journal. So purchase return journal, if you return the goods, okay, so if you return the goods, those are going to be, let me, you know what, make it. So if you return goods, that's going to be purchase return journal. Okay. So if you bought the goods on, let's say, this date, and then you will return the goods, but before that, yeah, there is a couple of terminology. So let's look at page 77. Page 77, yeah. So here we have purchase return journal definition. Here it says goods sent back to a business to the supplier. So that means you are returning the goods. Okay. And sales return journal means the customer is returning you the goods. Sales return is customer returning you the goods. Purchase return, you are returning the goods. Okay. Okay. Then we have definition on page 78. Next page, credit note. So credit note says the source document that records the amount to be deducted from or allowed against a previous invoice to avoid a business being overcharged. Usually the business has returned goods to the supplier. Okay, so what does that mean? That means, okay, I think I can draw something horribly. So let's say this is you. No, let's do it as a business, right? Let's say this is your business. This is your business, and this is the customer. So this is your business, and this is the customer. So when he buys the good, when he buy the goods, okay, so he is buying the good, you are selling to him. Okay, so he buy, maybe I can write here, he buy, and you sell him, and you give him goods, right? And he give you cash. I think remove the word this, I can write cash. So he give you the cash and you give him the goods. That's how it works, correct? But let's say I change the color perhaps. He want to return these goods. How does he do that? in order to return the good, he will request you that whether can return or not. Okay, he will request you whether can return or not. So usually you call this a debit note. Okay, this one is invoice. Yeah, so when he okay, so when he pay you cash and you deliver him the goods, you will issue an invoice because he pay you, right? It's like you go to 99 Mart, you pay something, they give you the receipt. So they you get the invoice. So this customer will request you. How he will request you? He will request you in some sort of document. It's actually the document is not here. Okay, it's supposed to be here. Anyways, it's not here. So he will request you that in terms of debit note. Maybe he request return for RM100. I mean RM100 worth of goods. Yeah. So if he want to request, he bought the goods, let's say for 500. So if he want to return, if he want to request for return, you are going to give him return. But it depends on you whether you want to give him return, whether he is fulfilling your policy, whether he is within the criteria of return. If he falls under return, you give him return. And how you give him return? You issue a credit note saying it's approval of debit note. Okay, it's approval of debit note. So you can say only 80 worth your request. I only 80 worth the goods that worth 80 ringgit are approved. 20 ringgit you take back. Those are okay. Those goods are okay. Okay. For example, he's returning the goods maybe because the goods are damaged. But when you look at the goods, you say, okay, this one is okay. But 80 worth of goods, yeah, acceptable. Those are damaged. So you give him back the. He haven't given back you the goods. Yeah, he's only requesting you. When you send him this one, then he will give you the goods. Or maybe he's giving you the goods along with the debit note. So the concept is something like this. Okay. So this is the credit note. So when I say how much the goods were returned, you cannot say 100 because I never approve 100. I mean, as a business, you never approve 100. You only approve 80. So the goods amount you are going to take will be the credit note amount, not the debit note amount. Yeah, because you can request for more, but if it's not accepted, it's not useful to us. Okay, that's the concept. I hope you get the concept. So that's the concept of credit note. So here we will be having the credit note number. If you look at the page 78, they have given us the picture of credit note. So credit note also looks like invoice, where you will have the quantity, the description, the amount per unit, and then the total amount. Okay, and perhaps you have the further description or the terms at the bottom of the credit note, like invoice. So in invoice usually we have, okay, if you pay within 20 days you will get 5% cash discount. Okay, something like that. Then we have definition for purchase return journal. So the definition says the books of prime entry used to list in date, order detail shown on the credit note relating to goods returned to supplier. So if you're returning the goods to supplier, you will be issuing credit note. So in this case, we are returning the goods. So we are this person and this is supplier. Okay, we are this person and this is supplier. So we get the credit note. Okay, and it does not matter whether we get the debit note or we issue the credit note, because uh, at the end of the day you are going to consider the credit note amount, not the debit note amount. Yeah, remember that. So if we look at the example on the book illustration 2, which is on page 78 also, uh, there is, you have purchase return description there. So Mangru Bennett and Mangru has returned the goods. So when they return the goods, you write the name in detail column. You write the date, what date they returned on, then you write the credit note number and the amount. Okay, and then you total up the amount. That's the concept. You transfer it into purchase return. So we know purchase is an expense, right? But purchase return, so return will be opposite. Okay, purchase return will be opposite. So in this case, purchase return, you have purchase return here 330, you are getting it from here. So in this case it will be 300. Okay, and then what you are going to do is similar thing. You open the account for ABC, XYZ and Bell separately. Okay, separately you open the account. There is no actually purchase return ledger, there is only purchase ledger, which is trade payable, because purchase ledger will have trade payables. So how much you are supposed to pay the two trade payables, you deduct the amount from them. Okay, I've just written purchase return for understanding. So this is the concept, same concept. And then we have here our general journal. Okay, if you have any other transaction, if it's other receivables, it will not fall, even if it's for return. But if it's for other goods, it will not fall under purchase return. So we have here source document, debit note and credit note. So debit note is issue when we want to return goods. So if we want to return goods, we issue uh, debit note, and the supplier will issue us the debit note. Okay, so supplier will issue the credit note. But let's say customer is returning us the goods, we will get the debit note and we will issue the credit note. So we will receive the credit note in that case, and we will issue the credit note to customer. Okay, so one is, this is perspective, because the business can issue also the debit note, but if you are this person, you can issue the debit note also. Okay, so it's about credit note and debit note. So purple one, this one is debit note, this one is credit note. So are you giving the credit note or are you receiving the debit note? Okay, you can be receiving credit note also, because this is one way transaction, right? So now we have sales journal, same thing. You have date here, you will write the date, then detail, then the credit note number, and then the amount. Okay, and then the total will go in the return journal, sales return journal. So this is general ledger. Okay, and then you are going to open the account for Amir. You are going to write the amount here 500, and then you are going to write the amount here. Okay, Abel. Now remember, this is sales return. Sales is income, but this one becomes opposite because return. Okay, now this is our trade receivable, normal trade receivable, huh? Not special trade receivable. But we, instead of debit, we credit, because let's say they bought the goods from us for 100 ringgit. They bought the goods 1000, because it's 500 won't make sense. You bought for 100 and then you're returning for 500. So let's say they bought the goods from us. They, so sales, I will write here sales, right? When they bought the goods, so I credit my sales and I debit my trade receivable. So when I debit my trade receivable, they want to return the goods for 500. I will credit it, because they no longer owe me this 500. Now they only owe me the balance 500. Okay, so if they pay 500 more here, let's say they pay via bank, settle or DD, done. Okay, that should be, that's how it should work. I will delete it. So that's the concept for this one. So the concept for this one is actually the same as the previous chapter. If you get the concept for the previous chapter, you should be getting the concept for this one. Okay, so let's look if we have any other key terms or definition. On page 79, there is a definition for debit note: a source document used by a purchaser to notify a seller that goods are returned and the amount that should be deducted from the amount due. Alternatively, a debit note is occasionally issued by the seller of the goods to notify the purchaser. So if you notice, they are specifically using the term debit note and credit note. They are using the term purchaser and seller not to make you confused, because they want to make sure you understand, are you looking from this perspective or are you looking from this perspective. Okay, because as a business you can receive credit note also, and from the other side, other end of the business, you can issue the credit note. One person will receive the credit note and other person will issue the credit note. Okay, so similarly go with debit note also. One business can issue the debit note and other business will receive the credit note. So you have to see, are you the customer or are you the supplier. Okay, so you have to see which perspective you are, uh, who are you in the situation. So in the sales situation, for example, this is sales, right? We are this person, we are the supplier. So we receive the debit note from the customer and we issue the credit note. For the purchase return, we are this person because we buy, right? This guy is buying, right? So we can request for the amount, we can issue the debit note to the supplier, and then we can receive the credit note. I hope that's clear. And then as usual, I will be expecting you to finish the questions, practice question at the end of chapter 9. Not many, but the concept stays the same. So I'll see you again.